Hello and welcome to the CNBC TV18 Investment Guide. I'm Surabhi Upadhyay, and as always, with me is Anuj Singhal, and we are here with another very interesting guest with another very interesting theme. Now, Anuj, this morning I was looking at Morgan Stanley's overall note on emerging markets, which was, of course, written by Jonathan Garner and his team, and it caught my eye because they said, you know what, 8 reasons why emerging markets, the index that is, the MSCI EM, could have peaked for the year. And then I saw the last line of that note saying India is perhaps an exception and this market will perhaps outperform.
You know what, yes, but you know, Surabhi, what we are discussing here in Investment Guide is not what this market will do for the rest of the year, right? What we are discussing is whether we are at the cusp of something big.
Yes.
You know, something big like we saw in 2003 to 7 phase. I think people have seen a lot of bull markets. I would still say that, you know, the 2003 to 7 bull market was perhaps the mother of all bull markets. I mean, I think that was the period in which, you know, really it felt like bull market. And yes, I mean, you felt that in between here and there, but that was the market in which, and not just bull market in terms of, you know, stock prices doing well, for the economy, you know, for your salary growth.
People felt good.
People felt good. You know, year after year, you were getting 40, 50, 60% salary hikes. Surabhi, ESOPs were making a lot of money. So I think that phase is still something which, of course, I remember. And that's what we're discussing in CNBC TV18 Investment Guide. Okay, and to discuss that, we have with us Ridham Desai, Head of India Equity Research and India Equity Strategist at Morgan Stanley. Ridham, thanks so much for joining us. Welcome to the show. Now, you know, talking about this cycle, right, 2003 to 7 cycle, do you think we are somewhere in that cycle, or is this phase reminding you of some other cycle?
So the challenge with markets is that every bull market, every bear market is different. There is some resonating, you know, there's something will resonate with some period in the past. But yeah, I think this comes quite much closer to the 03-07 phase than other phases. It's certainly not like the 91-92 bull market. You know, prior bull markets like the one in 84-85 was also very different. So in terms of mega bull markets, you know, there have been these 3 big bull markets in Indian history. This one probably compares more with the 03-07 phase. Global factors seem to be similar, and local factors also appear to be shaping up in a similar fashion. So I would say that it looks like that period.
Okay, Ridham, great to have you on the show. Thank you for you know, making the time for us. And we want to ask you a lot more. If it is looking similar to 2004 to 7, what are the similarities? And also on a larger sort of note, do phases and cycles always repeat almost absolutely similarly? Or will cycles have their own different texture and flavor as well? So what are the comparisons here?
See, I'll take the second part of the question first because that's an easy one. Bull markets or bear markets all follow very similar patterns in that sense, in the way prices behave or in the way sentiment behaves. They start with a mood of extreme pessimism, which then converts itself into doubt. Then it converts itself into some degree of optimism. And finally, a bull market ends with euphoria. Bear markets start at the peak of euphoria, and then they trough when people are extremely depressed, like they were in, say, March last year. So that's the similarity with all these market cycles, irrespective of which asset class you talk about, whether it's gold, whether it is equity shares, it doesn't matter. Now, on the first part of the question, that's a little bit more specific. How does this compare? The starting points were not very dissimilar. Let's assume for a moment that the starting point of this bull market was the last week of March last year, when the Nifty was trading at around 7,600. That was around 1.7, 1.8 times book. And guess what? In March 2003, which was actually 25th April 2003, I remember the date of that bull market. At the trough, the Nifty was again trading at 1.7 times book. So identical multiple. Then that bull market peaked with the market going all the way to 4.8 times book. So the valuations on a book multiple almost tripled. In that 4-year period or 4.5-year period, um, the Sensex or the Nifty companies compounded earnings at about 30% every year. So the book value also compounded, and therefore the Sensex went from around 2,800 to peak at about 21,000, which is what, about a 9-time increase. I'll ask you a question before I continue. Do you know what India's market cap was in March 2003? Any guesses?
I wouldn't have the number, but I'm just wondering how we've moved on book value now. I mean, just hearing you speak.
No, I said, what do you have any guess on what the market capitalization of the Indian stock market was?
Around 5 lakh crores, Ridham?
Okay, so I have the number in dollars. It was $120 billion. Okay, so that's
that's roughly 5 lakh crores.
Yeah, and it peaked in January 2008 at about $1.5 trillion. Okay. This March, we were down to around $1.2, $1.3 trillion. So the March market cap was equal to the peak of 2008, but of course, 12, 13 years have passed since then. So there are similarities in terms of how the valuation shaped up from the bottom. We don't know the top of this bull market, but if that bull market is an indication, then, this bull market could peak at about 5 times book. We're currently at about 3.5, 3.6 times book. Mind you, that doesn't mean that the peak is 30, 40% ahead because it takes time. So in the meanwhile, as the book compounds, there could be a lot more upside before we're done.
Okay.
The second similarity, and I think this is the most important thing, is about the policy environment. So if you look at the period between 98 and 2003, the then government had shifted emphasis from boosting the share of labor in GDP to boosting the share of profits in GDP. So there are 2 ways in which you can grow the economy. You can grow it by making the labor class richer. So the labor gets more income, it then spends. So consumption goes up, that lifts capacity utilization, and that causes companies to invest. As companies invest, it creates more jobs, and you get a virtuous cycle, and GDP goes up. The other way is that you boost the share of profits in GDP, and therefore you get an investment cycle, which then causes job creation, and wages go up, consumption comes in, and that creates a virtuous cycle of more investments and output goes up. Now, my belief is, and I'm not an economist, I've debated this with a few other economists who do not necessarily agree with this, that India is a country with excess labor and supply shortages. And therefore, it's the second model, which is the one that approaches from the share of profits, which works better than approaching this from the share of labor. And that is exactly what the government did between 1999 and 2003. It undertook several policy measures to try and boost the share of profits in GDP. Now, that particular government didn't see the fruits of its labor because we had a government change in 2004. But between 2003 and 2007, the share of profits in GDP went from 2% to 7%. And the nominal GDP, of course, was growing at about 13, 14%. So when you add that up, you got that 30% compounding in earnings. Now, a similar thing is happening here. The seeds this time around was sown in September 19. So in 2006, the then government in late 2006 enacted the Manrega Act and marked a shift in policy away from boosting share of profits back to boosting the share of wages. For 13 years, that policy impetus remained. And clearly, it did not help boosting GDP because we got a round of inflation and we got a round of bad loans, and it caused corporate sentiment to sink and investment stalled, and therefore job creation slowed down and wage growth slowed down eventually, and therefore it affected the output. In 2019 September, I sensed there was a marked shift in government policy. Through the massive corporate tax cut, the government basically said we're going to go back to try and boost the share of profits in GDP. And I think the finance minister said on your channel when she was asked the question of what is there in this particular budget for the working class, she said, I'm investing money, it'll create jobs and it'll create wage growth. And that thinking, I think, is very critical. We've seen several moves over the past 12 months, whether it's production-linked incentives, whether it's the new labor laws, the corporate tax cut, and several other things in this budget, which basically point in this direction. The government is now committed to reward the entrepreneur, to get profit share in GDP back up and rising, and therefore create an investment cycle which will then create jobs and will create prosperity for the working class. And I think this is the right model for India to approach, and it will result in, like we saw in 03-07, a pretty strong performance of share prices.
Got that.
Now there's a third factor which is very important in all this, which we should not ignore, which is the global factor. That period in 03-07 also marked a secular decline in the US dollar. Because the Fed had its foot on the pedal. And it seems like now that the Fed is committed, at least that's the Morgan Stanley view, the Fed is committed to keep interest rates low for a really long period, because it is committed to get inflation in the US back up to 2% and keep it there, which has not happened in the last 12, 13 years since the global financial crisis. So we may be in a longer term dollar decline, which augurs extremely well for Indian stocks.
Okay, got that. So Ridham, I have to ask you this follow-up then. That was the phase then in which infrastructure did the best, right? I still remember the prices of BHEL, L&T, GMR, all these stocks.
JP Associates of the world,
That's a poor reminder, or not a great reminder, but still, some of these stocks did really well. Are you seeing shades of that play out now? Could that be the space to be in?
So Nanuj, you're absolutely right. Measured from the bottom of 03 to the top of 08, the best performing sector in India was industrials. And I dare say industrials may again turn out to be a very, very strong performing sector. But the best performing sector, I think this time around, could be consumer discretionary. So industrials will be a close second, or maybe right up there. But I think discretionary consumption will do extremely well because India's income has changed. And there is a very big transformation happening in the consumption basket. Back then, which is almost 20 years ago, India was still consuming very basic stuff. Now we have started migrating out of that. Per capita income has grown. We're about $2,000. A large portion of the population is now above basic needs. And once that happens, the share of food in your consumption basket doesn't go up as much as your income. So it actually creates a lot of spare income to spend on other stuff. So the growth in non-food consumption is a whole lot faster than income growth. So I sense that discretionary consumption will probably be the best performing sector, and industrials will follow up closely. Now, the problem is in industrials is that a lot of the companies that were in existence then have actually shriveled and have even closed down and ceased to exist. So a new set of companies will be required, and we don't have such a broad universe of industrial companies like we had then. So again, that favors, discretionary consumption because that's a much bigger sector in terms of choice of businesses that one can participate in.
Okay, got that, Ridham. We have a lot of ground to cover. We have lots of other questions to know how to prep up for this new bull market. We'll take a break and come right back and also, of course, talk about this whole concept of the big getting bigger. What does that mean for your portfolios? Back in a moment. Welcome back. You're with us on the CNBC TV 18 Investment Guide, and we are in conversation with Ridham Desai of Morgan Stanley. Now, Ridham, you gave us some sense of, the pockets to look at in the market, discretionary consumption and, of course, industrials. Now, let's talk about size, because over the last couple of months, what we've all heard repeatedly is that big is getting bigger. So what does that mean in terms of stock selection? Do you stick more with large caps, with blue chips, or is this the time to actually go beneath the surface and seek out those mid caps and small caps for alpha?
So there are two things about this, Surbi. One is that we are coming out of a 10-year sluggish growth performance. When growth is sluggish, the pie available to businesses, it doesn't grow. And that is always unfavorable to smaller firms who do not have the same cost dynamics as larger firms. So larger firms get bigger and smaller firms suffer. And this has been the case for India as well, particularly over the last 2.5, 3 years, when economic conditions have been very challenging. That will change if growth picks up. So our view is that growth actually should do quite well over the next several quarters. And if growth picks up, the pie gets larger. Pie gets larger. Smaller businesses actually have more operating leverage, and they will do well. So I think this concentration, and we call it concentration of both profits as well as market cap, may have seen its peak, and may have seen its peak in December itself. So that may already be starting to decline, and you'll see that the profits of the broader market may grow faster than those of the Nifty and Sensex, and the market cap may also expand faster. So that's the first point. Now, this is happening within a bigger overarching phenomena of disruption. Now, disruption is it's an overly used word. Disruption has always been the case for businesses all through the history of the world. And I won't spend more time discussing that, but just go back to the 1870s to know what disruption was, because in a single decade we had a telephone, we had an automobile, and it completely altered the way people communicated and traveled. In fact, I wouldn't say the disruption that's happening right now even comes close to what we had seen then, 150 years ago. We also got electricity, by the way, then. So imagine. But disruption is an ongoing thing, and therefore you have to be very careful, especially with smaller businesses, because they can get easily disrupted with the technology changes that are happening. So when investors go around selecting that, of course, I think smaller businesses, generally speaking, should do better. But within that, you have to be careful that you're not buying a business that's getting disrupted because of some tech change that is happening in the world at large.
Okay, Ridham. Time permitting, I'll come back to that question for a follow-up on that. But, a two-part question. What's in the current cycle, what's the biggest risk to the market? And over a 3-year period, what are the factors to remember while making portfolios?
So, Anuj, I would say 2 risks. One is that at any point in time, if the market starts believing that the Fed has fallen behind the curve, then I think you have a problem. Because the Fed is still, the central bank that matters. And when the market believes that the Fed has fallen behind the curve, share prices will fall everywhere, and India will not be spared. And as a trailer, remember what happened in the taper tantrum in 2013. So that's something to keep in mind. The fact is that we think inflation is coming back in America. We also think that the Fed is going to be highly tolerant of that. But the market perception around this is going to be crucial. The second is, of course, the risk factor at home. There's a lot of execution. There's great commitment that the government is demonstrating about policy shift. The budget was a big surprise of the upside, but it still leaves a lot of work to be done. So, for example, the privatization of public sector banks that is being proposed has a lot of work, in the background that needs to be completed. So we have to keep an eye on execution, and hopefully that happens. And if that happens, then I think we should be okay. Because then, the point I made on policy will play out, and the share of profits in GDP will go up. So those are the 2 things I think investors need to bear in mind with a medium-term view.
Okay, Ridham, I just want to go back on the point of industrials, because the words ring so true, right? We have seen the demise of many companies in the last 10 to 15 years. So for those who are going to be focusing on the infrastructure sector, industrials once again, what are the most important, perhaps, parameters to keep in mind? I mean, there's L&T and then there's life beyond L&T, which is the argument that you just made. So, I mean, what kind of filters to look at, how to analyze some of these infrastructure and industrial firms?
So, see, Surabhi, I wouldn't distinguish between industrials or a consumer company. There are only 3 things that you look for when you buy a stock. You look to back good people, people with character, and people who are honest. Because if you get into a business that's managed by bad actors, then the result is usually bad. Why usually? It's always bad. You want to buy a decent business, not something that doesn't have much traction, something that is scalable. Scalability is a very important thing in the stock markets. So you wouldn't pay a multiple to a carpentry business, for example, because there is limited scalability there. So just a stray example that I gave. So scalability, and therefore that's the second thing. And the third thing is the price you pay for it. I mean, a business may have both the first 2 factors, but if you end up paying a very steep price, then you don't make money. So it doesn't matter whether it's an industrial or a consumer business or a bank. I think these are the 3 things that you're looking for: good people, scalability of the business, of a good business, and a proper price. It doesn't have to be a very discounted price. As Charlie Munger has said, you pay a reasonable price for a good business, you make money. You don't have to buy the business well below fair value, because good businesses tend to surprise on the upside with respect to their cash flows, and therefore you get compensated in the long run. Even if you pay fair value, you end up making money.
Okay, that's a very nice way to end, but that was not my favorite statement of the show. My favorite statement of the show, Ridham, was that it's right now is the best time to be an entrepreneur. I think for a lot of people listening, that's perhaps a good advice. Ridham, thank you so much for joining us. Always good talking to you.
Thank you.
All right. Well, on that note, we are going to wind up this edition of the CNBC TV 18 Investment Guide. Remember, we always look out for your feedback, your comments, questions, any new names you want to hear from. Tell us, and we will get the experts to you. See you next week.